On July 9, 2026, a renewed military escalation between U.S. and Iranian forces broke out in the Middle East. The exchange of fire immediately translated into a direct collision between physical energy supplies and global financial markets. This reaction began at the wellhead, moved through the Federal Reserve's policy chambers, and eventually reached the semiconductor cleanrooms of the AI sector. For an investor, surviving the coming months depends on calculating which of these massive opposing forces will give way first. The escalation is centered on the Persian Gulf, where American and Iranian assets are currently striking the physical infrastructure used to extract and transport the region's energy. This geography is the primary artery for global energy and trade, meaning any kinetic action here creates an immediate bottleneck for the rest of the world. When supply routes were similarly threatened during the 1970s energy crises, the result was a sequence of shortages that reached the civilian population, as seen in this $3 purchase limit sign. Before a conflict registers on a stock ticker, it manifests as a physical barrier that instantly disrupts the global flow of goods. Traders are now focused on the volatility of Brent crude, watching if prices will move back above the $80 to $90 threshold. If that threshold is crossed, import-heavy economies, including India, Japan, and much of Europe, will face immediate upward pressure on transportation and manufacturing costs. That inflationary pressure is already reaching the Federal Reserve. Minutes from their latest meeting show a group of policymakers who are increasingly divided on how to respond to these rising costs. This shows the current policy trap. As oil drives CPI higher, it physically blocks the Fed from lowering interest rates. This delay splits the market. Higher rates provide a positive outlook for banks, but pressure capital-heavy industries like real estate. Since the Federal Reserve cannot manufacture more oil, their only tool to suppress war-driven inflation is to make money more expensive to borrow. Even with these rising borrowing costs and the threat of war, European and U.S. stock markets have begun a steady recovery. The primary catalyst for this resilience is the unyielding demand for artificial intelligence infrastructure and the companies that lead the sector. These cleanroom technicians represent the physical side of the AI boom. Demand for semiconductors is currently so high that technology stocks have become the primary lifeboat for global indices. Investor optimism surrounding this technology is currently powerful enough to offset the negative pull of geopolitical instability. While some capital flows toward tech growth, institutional investors are also moving into safe haven assets to preserve wealth during this period of uncertainty. This has led to bullish runs for gold and the US dollar, while global bonds face downward pressure as investors rotate away from fixed income debt. These market shifts reflect joint warnings from the IMF and World Bank regarding supply chain vulnerabilities and the potential for slower global growth. Institutional wealth is now following a split strategy, bracing for immediate stagflation while simultaneously funding the next technological paradigm. The next 24 months follow two divergent paths. If oil stays above $80, the global economy faces stagflation. If energy costs stabilize, the AI productivity boom takes over. The outcome will be determined by the winner of the tug-of-war between the physical reality of Middle Eastern oil and the digital output of Silicon Valley semiconductors. For your daily intelligence on global finance, macroeconomics, and shifting market assets, be sure to subscribe to The Explainer. Every digital screen tracking these billions in tech wealth is ultimately kept on by a barrel of crude oil moving across the world.